Welcome to today's Canary Report. Markets are in a sharp correction phase as investors grapple with renewed concerns over AI capital expenditure and broader tech valuation multiples. Let's see what our canaries are telling us about where risk appetite stands right now. Speculative momentum has cooled significantly across the board, with ARKK down 2.21% and SPHB taking a deeper hit at 4.02%, while XBI managed to edge higher by 0.87%. The broader speculative proxies, including MAGS and XLY, are following the mega-cap tech lead lower as capital rotates out of high beta growth into more established value zones. This distribution suggests that traders view today's volatility not as a flash crash, but rather as a necessary correction in pricing. Credit markets are showing signs of stress without breaking down entirely, with the high-yield index trading lower alongside HYG and HYGW. The 10Y Treasury yield dipped to 4.49%, indicating that bond buyers were willing to lock in rates, despite the equity sell-off, though the slight price compression across high-yield sectors suggests demand softening, under pressure from Fed policy uncertainty. Investors are monitoring credit spreads closely as they await clarity on whether this is a liquidity event or a valuation reset. Volatility has spiked dramatically today, with the VIX jumping 12.79% to 19.49, while UVXY and VXX both posted multi-day gains exceeding 5%. This surge in fear is directly correlated with headlines citing a global rout in tech stocks and specific worries around AI spending efficiency among large-cap innovators. The compression of the IV curve, followed by an expansion, signals that option sellers are being forced to roll positions as hedging demand outweighs speculative buying. The real economy engine is sputtering under the weight of a concentrated tech drag, with SMH falling 6.61%, while IWM and RSP remain relatively resilient at sub-1% losses. Consumer staples like KRE actually posted gains today, suggesting that non-tech sectors are holding up despite the broader sentiment deterioration. This divergence highlights how much of today's downside is driven by sector-specific fundamentals rather than a systemic breakdown in corporate earnings potential. Defensive positioning is flowing into consumer staples, with XLP rising 1.69%, while traditional safe havens like GLD and TLT are underperforming or flat against the broader market. The dollar strength of 0.34% further supports this rotation, as investors prefer currency-backed stability over physical commodities in a near-term risk-off environment. Capital is clearly seeking liquidity preservation through defensive equities rather than long-duration bonds or hard assets right now. Today's session was defined by a tech-led multiple compression that dragged down speculative proxies and boosted fear. Fear metrics, though credit remains intact enough to avoid panic selling. The rotation into consumer staples indicates investors are hedging against further downside without abandoning risk entirely for full flight to quality status. Watch the AI spending data releases this week, as they could either stabilize sentiment or extend the correction, depending on how closely margins align with revenue growth expectations. That's your Canary Report for today. Stay vigilant around the tech valuation reset, and we'll see you tomorrow.